Bitcoin fights to hold $29,000 as fear of regulation and Terra's USD implosion hit crypto hard. Bitcoin leveraged traders show little interest in going long, even as Bitcoin price flirts with new lows below the $29,000. Bitcoin price initially bounced from its recent low at $29,000, but the overall market sentiment after a 25% drop in 5 days is still largely negative. Currently, the Fear and Greed Index, which use volatility, volume, social metrics, Bitcoin dominance, and Google Trends data, has plunged to its lowest level since March 2020. And at the moment, there appears to be little protecting the market against further downside. Regulation continues to weigh down on the markets. Regulation is still the main threat weighing on markets, and it's clear that investors are taking a risk-off approach to high volatility assets. Earlier this week, during a hearing on the Sentiment Banking Committee, United States Secretary of the Treasury Janet Yellen called for a regulatory framework of stablecoins and specifically addressed the Terra USD stablecoin plunging below 17 cents. Furthermore, the United Kingdom introduced two bills aimed at addressing crypto regulation on May 10th: the Financial Service and Market Bills and the Economic Crime and Corporate Transparency Bill aim to strengthen the country's financial service industry, including supporting the safe adoption of cryptocurrency. Meanwhile, searches for Bitcoin and crypto on Google are nearing their lowest levels in 17 months. And even me as a YouTuber can see it. Our views are the lowest it's been in years. Are people fearful? Or they just don't know what to do? Are they scared of regulation? Or don't they want to pay tax? But before continuing, make sure to look at Bitscap, a smarter way to automate your crypto trading. Best crypto trading bots, algorithmic orders, portfolio management, and free demo mode, all in one place. Automate your crypto trading with powerful bots. Bitscap helps you set simple and sophisticated trading robots to make a profit autonomously 24/7 in different market conditions. It even has a 7-day free trial so you can test it before you start paying for it. Back to the news. Terra Luna and USD, how we got here. Quick take. The historic debating of the Terra USD stablecoin this week sent shockwaves through the financial world. Here's a rundown on how we got to this point and why it all matters. Crypto history was made this week as one of the most popular stablecoins, Terra USD, lost its peg to the US dollar and then over the course of a few days collapsed below 50 cents. The stablecoin began to lose parity with the US dollar over the weekend, despite expensive attempts this week by USD backers to maintain the peg. The coin has fluctuated widely in the price and has failed to regain its peg. As of writing, USD is now trading at around 68 cents on Binance against Tether USD, the most voluminous trading pair for USD and Luna. Terra's native asset that is supposed to help USD maintain its peg is down to around $1.25 from $84 a week ago. USD situation is complicated and has unfolded very quickly. Here's a rundown on how we got to this point and why it matters. Setting the stage, a stablecoin is a type of cryptocurrency whose value is supposed to maintain parity with that of a non-volatile asset, most commonly the United States dollar. Traditional stablecoins like Tether USD and Circle USDC are said to be backed by cash and other assets. There are also crypto collateralization stablecoins, most prominently MakerDAI. USD, which was created by a startup called 𝙏𝙝𝙖𝙣 Labs, fits into the somewhat loosely defined category called algorithmic stablecoins. Instead of relying on collateral, these coins are designed to use market incentives to maintain their peg. Terra launched in 2018 with backing from Binance Labs, OKX, Halby Capital, and Tsunami, the firm behind Korea's Upbit. UST launched in fall of 2020, and the stablecoin saw massive growth during the bull market of 2021. Don Kwon, CEO of Terra Labs, described how UST is supposed to work on a recent episode of The Scoop. The idea is that at any given time, a person can burn $1 worth of Luna in order to mint 1 Terra USD. And vice versa, you can always redeem 1 Terra USD for $1 worth of Luna. So, insofar as the Luna token has some sort of market value, you can always try to arbitrage against the system in order to mint and redeem tokens, just in case a depending event happens. So, for example, if Terra USD is trading for 90 cents, a arbitrator can simply buy up Terra USD from the open market and then trade it against the protocol for $1 worth of Luna, thereby capturing 10% arbitrage profit that way, and vice versa. If Terra USD is ever trading at $1.10, you can buy $1 worth of Luna from the open market, mint Terra USD, and then sell that to capture 10% profit on the other side. That's supposed to maintain the peg, but beyond that, a non-profit base in Singapore called the Luna Foundation Guard, or LFG, had been raising enormous amounts of funds, mostly in the form of Bitcoin, to serve as a forex reserve for USD. In February, the block reported that LFG has raised $1 billion to form a Bitcoin reserve for USD. In March, Don Kwon revealed that LFG upped the number to $2.2 billion for its Bitcoin reserve and had a long-term goal of $10 billion. In April, it added $100 million in AVAX tokens, an additional 231 million worth of Bitcoin. On May 5th, LFG said it had purchased 1.5 billion worth of Bitcoin, bringing the total in the reserve 3.5 billion. Did collapse. Then something happened this weekend that caused a large amount of USD selling. As crypto researcher and former researcher at the block, Mika explained on another recent episode of The Scoop, on-chain data showed that a lot of large selling of USD into other stablecoins. The reason for this is still not entirely clear. I think the reason for it is clear. Make sure to watch my previous video. The selling pressure caused USD to lose parity with the dollar. That's not the first time this has happened. In May of 2021, the price of USD fell as low as 96 cents before recovering. But on Monday, the price fell to as low as 61 cents. The same day, the LFG said it would defend the peg by lending out 1.5 billion in Bitcoin from its reserve to over-the-counter trading firms so they could support the market activity and help maintain parity for the dollar. Early morning, Eastern Time on Tuesday, Binance suspended Luna and USD withdrawals. Later that day, the stablecoin regained some of its losses, climbing back above 90 cents. Then the block reported that LFG was seeking 1 billion more from large crypto investors. Later on Tuesday, the price began declining quickly again, falling to around 30 cents. On Wednesday, one of the big four exchanges in Korea suspended Luna trading to its user, affecting how some traders in certain parts of the world can restabilize the Terra ecosystem. Meanwhile, Anchor, the native token of Terra dominant by platform Anchor protocol, is down more than 70% in the last day. Before the UST collapse, Anchor, which is supposed to pay out 19.5% yield to lenders of UST on the platform, was already on pace to deplete its own reserve within 2 months. Why it matters. On Wednesday, Don Kwon laid out plans to helping bring USD back to the market parity. The plans include absorbing the increased USD supply from holders, selling it off, increasing Luna minting by 400% to let more USD holders cash out, and increasing the amount of USD that can be sold for Luna each day. But the collapse has left a huge amount of uncertainty and distrust in its wake. It's far from clear that it will ever regain its peak, but much less the trust is need to be sustainable. Besides that, the fallout will have massive implications for the cryptocurrency and DeFi scenes more broadly. To begin with, Ethereum's approach in stablecoins unavailable. Other layer ones, including Tron and the Near protocol, plan to pursue similar designs. The ultimate goal is to create truly decentralized stablecoins that are beyond the reach of regulators. Speaking of regulators, if they weren't paying attention to this trend before, they certainly are now. In a Senate hearing on Tuesday, US Treasury Secretary Janet Yellen referred to UST by name as she once again asked Congress to pass legislation regulating stablecoins. I think that this simple illustrates that this is rapidly growing product and there are rapidly growing risks. Said, yes, of course she's gonna wanna regulate it. Why? In my opinion, fiat currency is scared of stablecoins and cryptocurrency, and they need to do something. Terra collapse could spell end for algorithmic stablecoins. As Terra Labs and community members scramble to rescue stablecoin Terra USD, regulatory experts say the collapse might be the end of algorithmic stablecoins as we know it. It is sad ending to the innovative algorithmic stablecoin experiment. Adil, head of portfolio management at Securities, said algorithmic incentives for stablecoin pegs remain an unsolved problem. USD collapsed dramatically this week, depegging its goal base price of $1 and reaching a low of 29 cents earlier today, according to CoinGecko. The token adjacent cryptocurrency Luna plummeted from $86 last week to around $27 at the time of publication. The situation is a real-time proof that lawmakers' concerns about the stablecoin industry are justified, according to the US Treasury Secretary Janet Yellen. It's quite common that we wake up to regulation only when we have a crisis, said Jonathan, CEO of eCurrency, which provides technology for central banks to issue and distribute central bank digital cryptocurrencies, or CBDCs. A call to action is probably what I would call this situation. For months, regulators have promised that rules to protect investors are coming, but lawmakers across government agencies cannot seem to agree on a path forward. Stablecoins are a form of private money, he said. Trouble with that is that stablecoins issuers make up their own rules and nobody knows whether the rules are appropriate. Other stablecoin issuers should expect greater regulatory scrutiny. Abdullahi agreed, but it's also important to consider the type of stablecoin. Reserve-backed tokens such as Circle and Tether have, at least according to the teams behind the coins, robust reserves of safe haven assets such as cash and cash equivalents. Algorithmic tokens such as USD rely on smart contracts that put incentives in place to maintain the price. Algorithmic stablecoins still need work, Abdullahi said. None have worked. A recent research report from Wake Forest Law Review went further, claiming algorithmic stablecoins are inherently designed to fail. These tokens require a support level of demand for operational stability and rely on independent actors with market incentives to perform price stabilization. Arbitrage, the report said. None of these factors are certain, and all of them have proven to be historically infamous in the context of financial crisis or periods of extreme volatility, the report noted. Other issuers should consider UST collapse as a warning. Said. One would assume, in good faith, that all stablecoin issuers have actually thought through what the risks are, and that managing those risks is an active part of what they are doing every day. However, I'm going to guess that that's not really the case. So I do agree with the regulation, but the way it's getting approached, waiting for things to fail and then want to jump onto it, is not the right way to go. Come up with a plan that suits everything. Don't use one failure as an example to get what you want as a government. Leave me your thoughts and concerns down below and let me know. Do you think Terra Luna will survive or is it the end? Have a great one.